JB Pharma's Q4 FY26 results just dropped, and while the headlines scream trouble, the actual data tells a massive story of a strategic transformation that every investor needs to understand. We are unpacking the transient pain, margin miracles, and the Torrent integration. Today, we're dissecting the revenue and profit dip, looking at the health of the India versus global segments, and explaining how gross margins hit a staggering 70%. We'll wrap up with the financial fortress of the balance sheet and a final verdict. On the surface, the numbers look rough. Revenue hit 904 crore rupees, down 5% year-on-year, and reported profit after tax fell 30% to 101 crore. However, this was impacted by a deliberate phase-out of low-margin trade generics. Despite the dip, gross margins climbed to 70%, and the secondary market in India grew 11%, beating the industry average.
Don't let that 30% profit drop fool you. It was driven by a strategic operational reset. The decline includes 38 crore in ESOP charges, which is a non-cash dilution, and exceptional items like severance and labor code gratuity. Revenue was also dragged down by deliberate network optimization, meaning these costs are primarily one-off integration expenses. The synergy under the new Torrent Group management is real and working. Gross margins expanded by 400 basis points to reach 70%. Adjusted EBITDA stood at 241 crore, with a margin of 26.7%, remaining resilient despite lower scale. For the full year, the EBITDA margin reached an impressive 29%. Where is the growth coming from? The India business is the star performer, reaching 2,461 crore and growing 9% year-on-year. Most importantly, the chronic portfolio surged by 19%. International revenue hit 1,154 crore, but dropped 9% in Q4 due to Middle East shipment delays. The CDMO segment remained flat at 445 crore due to customer inventory reductions.
JB Pharma has built a financial fortress. They are virtually debt-free, with only 36 crore in total debt, down from 141 crore. They hold 146 crore in cash and bank equivalents, and their net worth has jumped 21% to 4,159 crore. With a current ratio of 4.92x, they are highly liquid and ready for any shocks. This company is a cash-generating machine. For the full year, they reported a profit of 709 crore and converted almost all of it into operating cash flow at 704 crore. This nearly one-to-one conversion proves their earnings quality is high and not driven by aggressive accounting. Free cash flow remains strongly positive at roughly 619 crore. Treasury management is a major focus, with an outflow of 2,274 crore into investments to maximize yield. Even with this reinvestment, shareholder returns remain a priority, as they have recommended a final dividend of 9.30 per share, which is a 930% payout.
Let's look at the traffic lights. The green flag is that stellar cash conversion. The yellow flag is an inventory spike, up 29% to 683 crore, caused by logistical constraints and Middle East delays. We need to watch for aggressive inventory clearance in the coming quarter, but importantly, there are no critical red flags. What's the bear case? Integration volatility with the Torrent Group could cause more lumpy revenue drops. Logistics friction in the Middle East threatens international recovery, and there is a concentration risk since they are heavily dependent on the India business for their margins. Now for the bull case. Chronic dominance is key, with that portfolio consistently crushing industry averages. The leap to 70% gross margins proves that procurement efficiencies are working flawlessly. Plus, the strong dividend payouts reward patient investors while the integration finishes. The bottom line, the Q4 dip is deceptive. The drops were driven by a strategic, one-off reset, not a broken business. The core is actually stronger, with 70% margins and 19% chronic growth. Just keep a close eye on the inventory unwind in Q1. Do you see JB Pharma's Q4 dip as a warning sign or a major buying opportunity? Drop your investment thesis in the comments below.
If you found this JB Pharma earnings deep dive helpful, don't forget to like, save, and share this video. Follow and subscribe to ZinvestZ for more smart investing insights. Thanks for tuning in.